Hey everyone, today we're going to take a deep dive into the officer compensation box of step 3 of the BizEquity software. We prepared this Excel spreadsheet, which provides a general overview as well as some specific examples that we can walk through that help handle owners' compensation cases. First things first, it's important to understand that the BizEquity software primarily revolves around what is known as seller's discretionary earnings, which is a measure of adjusted cash flow. Now, this SDE or seller's discretionary earnings attempts to get to the cash equivalent benefits accruing to a single primary owner operator working full time in the business. A lot to unpack there, but we really need to focus on single primary owner operator. So, if we have multiple partners, we really need to boil that down to get to the cash benefits accruing to a single owner only. So, we'll make some adjustments there. Next, full time basis. So, to the extent that an owner is part time or absentee, we will also need to make adjustments to bring them to a full time basis. So, we got to, step 3 of the tool. We're at the owner's compensation box, and we're looking for an understanding of how to put the most appropriate number in there. So, the first thing we need to do is identify who the primary owner is in the business. If the client has only one owner, then that owner is the primary owner, and we will add back all of their historical compensation for that year and include it in step 3 of the BizEquity software. If there are multiple partners, we need to identify the primary owner, and then for each additional owner, we need to take their historical compensation and compare it to a market salary. So we have an example here that might be a little bit easier to follow. So in our example, we've identified a primary owner as making $200,000 a year. Next, we go to the secondary owner and say, okay, they made $150,000 annually. To replace this level of work would cost $100,000. So there's actually $50,000 of excess here. We move to the third owner, following that same logic. They had historically been making $125,000, less a market salary of $100,000 for an excess of $25,000. Moving to the fourth owner, who's being paid $75,000. To replace them would cost $75,000. So that's a wash. And next we move to the fifth owner, who had historically been making $50,000. To replace their level of work would cost $100,000. So there's actually a shortfall there of $50,000. So if we go back over here to follow this calculation mechanically, first we add back all of the compensation paid to the primary owner. Next, we add any excess or shortfall from comparing what that secondary owner had been making, historically to what it would cost to replace them. We do that again for the third owner. In this case, it's the $25,000. Fourth owner, and as well as the fifth owner. Remember that the fifth owner had been making $50,000. But if a new owner had to come in and replace this level of work, it would cost them $100,000. So there was a $50,000 shortfall. Next, we sum all of this up, and this is what is included in step 3, the owner's compensation box in the BizEquity software. Now, naturally, a question might be, how do I identify who the primary owner is, especially in cases where there are 5 partners or more? So what you can do is take a look at the tax return and look at the split between the ownership percentages. That should be a pretty good indication of who the primary owner is. We could also take a look at office or owner's compensation, see who's getting paid more. We also should consider the work effort, who is actually running the day-to-day operations of the business. Okay, so we have an outline of some scenarios here. We can go over some general overview. We have single owner working full-time, single owner working part-time, single owner who is absentee, multiple owners working full-time, multiple owners working part-time, and then multiple owners who are absentee. Jumping right into the first example, we have a single owner working full-time in the business. Okay, so we go through the financials. We see that the owner is getting paid a salary of $200,000. We add back payroll taxes, benefits, and perks for another $25,000. So historically, this owner had been making $225,000. This is what would get entered into the BizEquity software under the owner's compensation box. Okay, so moving on to example 2, we have a single owner working part-time. For our example, we will assume 50% of the time is in the business. So again, we go and look at their financials. We see that they are being paid $50,000. another $10,000 in benefits and perks for a total of $60,000. Okay, next we can go ahead and calculate the potential cost savings if if an owner comes in and works full-time in this business. So remember, this owner is working 50% of the time currently. So it follows that a top manager or employee is, really covering the day-to-day operations while this manager isn't here. Well, if I were to come into this type of business and I'm going to provide, a full-time work effort, I don't necessarily need this top manager employee to work the same amount of hours or perhaps for even the same amount of pay in theory, right? So, I could come in and cut these hours or really cut this position in half, and because I will be performing the duties that this top manager currently is. So in essence, there's a cost savings potential there. So we can go ahead and say, okay, this is 60,000 is what that owner had been making, historically. This top manager had been making $80,000 a year. We're going to assume 50% of that, can get added back as a cost savings for a total of $100,000, which would be entered into the BizEquity software. Moving on to example 3, very similar to our previous example. We have a single owner who is absentee. So again, we will take a look at the financials. We will find out what they had historically been making, $60,000. In this case, we will add back the potential cost savings for the manager. And then we have a total of $140,000 of total compensation to be entered into the tool. Remember, the logic is, $60,000 is what that owner had been being paid. And then again, we always think in terms of a single owner operator working on a full-time basis. So if I come in and I purchase this business, well, this owner is absent and making $60,000. Well, if I come in and work full-time, I don't need this top manager to provide that work effort anymore because I'm going to cover this. So this position could be eliminated. So that's an $80,000 of potential cost savings. Okay, moving on. Partners working full-time. So the first thing we need to do is add back all of the compensation paid to the primary partner. We take a look at the financials. They've been making $200,000 in salary, another $25,000 in taxes, benefits, perks, for a total of $225,000. For the next owner, we will compare them to a market salary, but first we will see what they historically been making. So in our example, they had $100,000 of salary, another $25,000 in benefits and perks, for a total of $125,000. Next, we take a look at their work effort, their responsibilities, and we estimate a market salary of $75,000 for this position. So there is an excess here of $50,000. So remember, this means that, currently this partner is making $125,000. Well, I don't necessarily have to bring in a partner if I purchase this business and pay them $125,000. I just have to, hire an employee at a market level salary to cover the same amount of work. So if I were to do that, we're estimating that would be $75,000. So really, there's a cost savings of $50,000 if I replace this partner with an employee. So we'll go ahead and say, we have $225,000 is what that primary owner was, plus, this $50,000 of excess for a total of $275,000. So this is the owner's compensation that would be entered into the tool. Okay, multiple owners working part-time or semi-absentee. So kind of a combination of a few of these examples. So what we need to do, same starting point as always, is identify the primary owner and then find that owner's compensation. So in our example, that primary owner has been designated. They are receiving $50,000 in salary, another $10,000 in benefits, for a total of $60,000. We're going to assume that this manager is working 50% of the time, so there could be a 50% cost savings on that top manager or employee. Again, similar to before, we'll assume that top manager is making $80,000 a year, really kind of covering the 50% of the time that that the current owner isn't there. So we can have a cost savings of $40,000 for a total of $100,000 for this primary owner. Next, we're going to take a look at the secondary owner compensation, and they are making $50,000 historically, another $25,000 in benefits for a total of $75,000. We will take a look at the replacement cost for them. In this case, we'll say it's $30,000, with the excess being $45,000. And we can go ahead and add the $100,000 of adjusted primary owner compensation to this excess from comparing the secondary owner to a market level salary for a total of $145,000. Now, one thing to remember especially when we're calculating secondary owner replacement costs or third or fourth, whatever owner it may be, is that we need to compare the replacement cost to the level of hours. So if this owner is working half time and a replacement cost for a full-time person is, $60,000, then, we need to break that down to a 50% replacement cost. So it'd be $30,000. And moving on, multiple owners who are absentee. So here, same as before, we're going to go ahead and calculate the officer compensation for the primary owner. That's $50,000 plus another $10,000 in taxes, benefits, perks for a total of $60,000. Similar to before, except the manager is fully absentee. So we'll add back all of that top manager salary because that could be a cost savings for a total of $140,000. Next, we move to the secondary owner. We see what they had been making historically. We go through their financials. They were making $50,000, another $25,000 in taxes, benefits, and perks for a total of $75,000. We will compare that to a replacement cost for this owner for a excess of $45,000, and then again we are taking the adjusted primary owner's compensation, adding the excess here, so we have a total of $185,000 that can be entered into the tool. All right. Another common situation that arises is family members in the business and how to treat them. So we generally have a couple different situations that can occur. You have family members who are working in the business, so they're providing work, but they're not being compensated. Next, you have family members who are working, but are being undercompensated. Then you have family members who are being compensated, but aren't working at all. And then you can have family members who are working, but are being overcompensated. And we have a few examples. So going right into number one, family members who are working but not compensated. So, first things first, we can calculate, okay, they're not getting paid anything. So that makes this box pretty easy. Move down to a possible replacement cost. So we have to take a look at what they're doing in the business and how much they actually should be being paid and calculate that and say, okay, well, you have a shortfall here of $30,000. So we can make this adjustment directly to the owner's compensation box, or we could put it as a one-time gain in the BizEquity tool. So remember, we're really trying to make an adjustment to say, hey, if a new owner comes in, they have to replace what this family member is doing. That replacement cost is $30,000. So we actually need to bring down the amount of potential owner's compensation by $30,000 because they're going to have to pay some of that money to hire someone to do the work this family member was doing. Moving on to example 2. We have family members who are working but are being undercompensated. So very similar approach. We'll say, okay, this family member is doing a lot of work, but we can only pay them $20,000. But really, they're doing about $40,000 worth of work. So if I were to come in and pay this business, this family member is going to leave. I'm going to have to hire an employee to do, what this family member is doing, and that's going to be another another $20,000, so a total of $40,000. So it's actually going to cost me $20,000 more dollars. So I need to reduce the cash flows by that. So I can reduce the officer or owner's compensation by $20,000, or I can, include that as this $20,000 as a one-time gain. All right. So next we have family members who are being compensated but are not working. So they're receiving a salary, but they're not actually doing anything in the business. So there really is no replacement cost because they're not doing any work. Now, in this case, it's actually a positive adjustment, right? Because it's an expense on, the current business that the new owner won't have. There actually will be another $50,000 of cash flow to a new owner because this family member won't be here receiving a salary for nothing. So we have this $50,000 of adjustment. In this case, we can add this $50,000 to the owner's compensation box, or we can include it as a one-time expense because it's an expense that the current business is incurring that a new owner would not. And finally, we have family members who are working but are being overcompensated. So, you have a family member, they're maybe doing some bookkeeping or maybe they're helping with computer stuff a couple times a week, perhaps it's worth $30,000 what they're doing, but they're getting paid $100,000. So very similar. The adjustment here is, they're getting paid $70,000 more than what they should. So that can get added to the owner's compensation box or one-time expense in the tool. Again, the thinking there is that the current owner is paying $100,000. If I were to come in and pay, one of my employees, I only need to pay them $30,000 to do the same amount of work because you're overpaying them currently. So there's another $70,000 available to me. All right, so that wraps up. I'm sure there may be more questions, so please feel free to reach out and we can walk through any specific examples, but hopefully you find this helpful.